we're excited to hear from Jesse Thompson, Senior Business Economist at the Federal Reserve Bank of Dallas. He will discuss the latest trends and opportunities within the RioPlex economy. Thompson, who joined the bank in 2010, performs research and analysis on issues affecting the Houston and Gulf Coast economy. He studies issues specializing on hydrocarbon industries. He also collects information for the Dallas Fed's Beige Book, Summary of Current Economic Conditions. He is the author of the Monthly Energy Indicator and Houston Economic Indicators. He also contributes to the publication Southwest Economy. Thompson earned an MA in economics with emphasis on empirical microeconomics and BA in philosophy and economics from the University of Houston. Please join me in welcoming Jesse Thompson.
Good afternoon. So, many of my slides have not been updated in the last 30 minutes, so they may be out of date. So the title of my slide is Return to Trend ? And this has been the title throughout the year. Right now, I would say, so up until the most recent several weeks, the question wasn't, is Texas economy, or is even the US economy, but is Texas economy specifically going to slow down in 2025 and 26 relative to where we were doing in the last 2 years? We knew it was. The question is, just how slow does it go? And it looked like we were heading in for trend growth. Now, before I go into all of the details, let me just warn you that my opinions are mine and mine alone, and not necessarily representative of the views of the Federal Reserve Board of Governors, bank presidents, officers, or anyone else associated with the Federal Reserve Bank in any way, shape, or form. Now, I have way too much content in my slide deck to go through everything with you today, so I'm gonna have to skip through some things because I really think we want to focus on the Q&A. Here's a brief summary of tell you what I'm gonna tell you. I'm gonna start off high altitude, and I'm gonna zoom into a couple of our key industries, and then I'm gonna give you sort of the forecast stuff. And I apologize, I'm gonna have to skip through some slides here in the interest of time. Throughout, if you see something and you have a burning question that you need to ask, feel free to interrupt me, raise your hand, and I'm happy to address your question if I can, as we go along. So first off, business conditions. What has happened? So where we were, things were improving heading into the end of 2024. Companies were very optimistic at the start of the year. And then over the course of the last 3 months, business conditions have worsened. Uncertainty has spiked. And if you look through the survey comments for the Dallas Fed's manufacturing surveys, its energy industry surveys, there are a number of, you can look at the ISM, the Institute for Supply Management, the Purchasing Managers Index surveys. Nationwide, businesses are increasingly pessimistic and negative about the economic outlook because of tariffs. And not just the imposition of tariffs, but because of the uncertainty around not only those tariffs, but a number of other policies. And that uncertainty is a kind of tax. It is a tax on businesses' capabilities to make decisions. Businesses are highly innovative. They find solutions, they find a way to get things done, so long as there's clarity about the rules. What does the world look like that we're operating in? We'll figure it out. But if you don't know that first part, you can't do the second part. And this is this big question mark that we're dealing with in our surveys. First off, overall, Texas investment and new construction are robust, all right? And that's not going anywhere anytime soon yet. I'm gonna talk a bit about that. Amid very well-supplied energy markets. Some downside risks have emerged in the past week and a half for our key industries, but also some good things. US looks to be on course for trend GDP growth and full employment, or less. And that's the thing, it's gonna be or less. And you'll see some numbers here towards the end. And then Texas job growth. The forecast has been bouncing around quite a bit, and I just had to update it this past week for a big thing that we've got going on. It's been oscillating around trend, meaning what is the average growth rate of jobs in Texas? We focus on jobs because jobs are the best data we have on the regional economy. The GDP data is of questionable quality, and it comes late. It comes much lagged. So we look at jobs. Trend growth for Texas is about 1.7%, meaning through the business cycle, you can generally bet on somewhere around 1.7% growth being sort of the long-term trend based off of the last couple decades. That's slower than it used to be. The state has slowed down as it has matured and diversified and grown. Diversified into services, diversified into things other than energy. So much so, in fact, that it used to be that you didn't need to know what was happening to GDP nationwide. All that we really cared about in Texas in the 70s and 80s is the rest of the country burning gasoline or not. Didn't need to worry about other factors. And that has changed dramatically to where even the shale bust of 2015 and 2016, which by almost any measure was as big, if not bigger, than what happened to the energy sector in 1984, Houston and the state of Texas overall didn't, and particularly the state of Texas overall, did not see a recession. Just a mild slowdown. Even the city of Houston did not see a recession by almost any definition. Slowing to trend was inevitable, but going forward, I would say risks are weighted to the downside. So, moving along, let's start off with the backdrop. What is happening in the macroeconomy right now? And I apologize, a lot of these slides are gonna feel really stale given the a year and a half worth of headlines that have occurred in the last 2 weeks. Sharp slowdown in consumer spending and jump in imports drag down first quarter GDP estimates. So first quarter GDP is slowing substantially. Now, the question that we're asking ourselves is the slowdown in consumer behavior that we've seen so far this year, is it driven more by the fact that that consumers spent so much more than people were expecting in the fourth quarter of last year? And so you see a big slowdown, a bigger slowdown than you would normally see. Or is it that the consumer is finally, after 2 years of prognostications, running out of steam? I don't know the answer to that question. But now we're adding tariffs. And now we're adding trade wars and what that does to consumer prices, at least in the short run. In the short run, it pushes prices up, and so we're worried about some further weakness in the consumer that might develop. But this number right here is the thing that's been driving it, and people, we've seen it in our reports, the volume of things that companies have brought in trying to get ahead of the tariffs has dramatically surged, and that's a big part of what's happening here. Unemployment, I'm just gonna say, by any measure up until even just this week, we're at full employment. The labor force, labor utilization rates are very, very high. People want a job. It's not as easy as it was a year ago or 2 years ago, but a lot of people are getting it. They're still getting jobs, they're still transferring. And in Texas, I will add, as you'll see in a bit, in Texas, I'll add, our unemployment rate is generally higher than the nation. Our metropolitan areas tend to have higher unemployment rates, not because conditions are worse here, but because, as you heard in the last presentation, migration into the region. When people move here, they generally don't always come with a job. So they come here and then they're in the process of getting a job. And so as the labor force grows in Texas, it tends to put upward pressure on our unemployment rate, which is why Texas typically has a higher unemployment rate than the nation, particularly post-pandemic in the last couple of years. Now, I want to add wages. This is our best measure of wages, this employment cost index, wages and salaries. And by the way, this slide deck will be made available to you. It is available to you. They can send that out. So I'm sure all of you are dying to read it and email me later with questions. So you feel free. Wage growth spiked post-pandemic. We had labor shortages. Labor markets were very, very tight, and we saw wages year over year really rise up. The red is the United States, and then I have Houston because I always have Houston charts, but and then you see the state of Texas overall about 4%. Now, this is trending down. It's trending down because you can't recover from the pandemic more than once. You can only do it once. After that, you're done. Please be done. So this is slowing down. Just for you guys, why do you guys need to know this? Because you maybe care about inflation and outlooks. Historically, as a rule of thumb, not a forecast, but just as a good rule of thumb, historically, this number, wage growth, needs to be averaging somewhere closer to 3% year-over-year growth in wages to be consistent with 2% inflation. Because if people's real wages are growing this much, what are they doing? They're generally buying more stuff, particularly buying more time by buying more services from a wider variety of companies. They're also getting bigger, better TVs and other things like that, but it's the services part that is the most interesting. And so that's something that's going on. Inflation, I'm not going to belabor the point here. It's been slowing down. It has been stickier than we thought it would be. And the forecasts for this year, last month, were already that inflation progress would slow to a crawl this year. And I can tell you, as forecasts are being updated, the forecasts for inflation this year are starting to tick back up, at the same time that the GDP forecasts are going down. So the potential for stagflation in the economy is rising. One thing that has gotten a lot of headlines, and by the way, the Dallas Fed, if you go to the Dallas Fed website, we just had a seminar on trade issues and immigration issues and what it means for the economy. I highly suggest you go to our webpage, check out the YouTube video that is available for you to watch, where we cover this. This is migration to Texas. The dark blue is domestic net migration, people moving to Texas from other states. All right. As you heard, people have been moving to Texas from other states at a high rate for a long time. In this period, what was happening? Texas was growing, it was doing very, very well, and in particular during the 20-teens, the US economy overall was relatively modest and slow. The post-Great Recession years saw relatively little growth nationwide compared to what was happening in Texas, which had been multiplied and accelerated by what was going on in oil and gas. Because oil prices, you might forget, were about $100 for several years. WTI, West Texas oil, was about $100 for a couple of years. And Texas never saw a $100 barrel of oil that it didn't love and immediately sent a whole bunch of people out to buy brand new F-150 trucks. Like, that happens. Now, of course, the shale bust happened, and for several years here, we had a dearth of migration into the region because while the Texas was slowing down, the rest of the country was picking up. And so people said, well, gosh, at the margin, I'm going to stay over here. The opportunities aren't that much better in Texas. And then you saw a surge. That surge was driven by a couple of things. I'm not going to belabor the point of all the different factors that drove that surge in immigration, but one thing that was key was an ongoing shortage that was being answered because we'd had lower migration for several years. Shortage of workers. And so you see a surge in immigration here, and this is international, and yes, this does include all forms of migration. This is bodies. This is not differentiating between legal or undocumented or illegal or however you want to call it. You're just seeing a surge this is the bodies that are coming here. And however you feel about that, and many, many people have very perfectly justified views that we all can agree or disagree on, depending on where we're coming from. But one thing that isn't in debate is that in the macro, and certainly we saw it here in Texas, it was a boost to total job growth, it was a boost to total GDP, and based off of the analyses that we have seen, which leave a lot to be desired from an empiricist's standpoint, a lot to be desired. When we look at the surge in immigration that we saw here, because there was a relative shortage, when we look at those towns and sectors that are most exposed to undocumented migration, we did not see any suppression of wages compared to other sectors. In fact, if you look at the data for wage growth from 2020 to 2023, it was the less education, lower educational attainment jobs. It was individuals who did not have college degrees, many of whom did not have high school diplomas. It was those sectors, the bottom half of the distribution, the bottom quarter of the wage distribution, that saw the strongest wage growth from 2020 to 2023. And so it's hard to be exact about what the contribution was to wages, but this whole sector, this surge of immigration allowed Texas to helped Texas outperform the US overall, because we had a disproportionate, we're a destination state, and the US as a whole did better than a lot of other developed nations, in part because people were coming here, whereas many other countries did not have immigration. That looks like it's going to reverse a bit. We're very concerned about this slowdown in domestic net migration, and we know that the total international migration is going to, the most recent estimates I've seen, it's expected to drop by about half, maybe more. We shall see. This is just telling you what I already told you about businesses. I'm not going to belabor the point, but we have a lot of surveys. We really like hearing from businesses about how things are going, and what you're seeing here is that manufacturing finally found the bottom of the trough nationwide, but particularly in Texas last year, and it was starting to grow again in aggregate. And now looks like maybe things have kind of turned a corner here as Texas has been particularly exposed to a lot of the talk on tariffs, particularly with respect to our two biggest trade partners, Canada and Mexico. Now, thankfully, at least in the most recent data that was available, Canada and Mexico, well, particularly energy trade, but also trade with Canada and Mexico, as long as it's USMCA compliant, we actually got a pass. So energy trade is not going to be subject to the same kind of tariffs that we were worried about, and that's a big deal for Texas. And certainly anything underneath the umbrella of the USMCA is going to be at a much lower tariff rate than we had feared a week ago. That could change by tweet by the end of the day, but that is sort of the state of play. Job growth in Texas over the past year is broad-based. As was noted earlier, we typically outgrow the nation, although you'll note last year we did not outgrow the nation by much. Texas does tend to outgrow the rest of the nation. It is a job growth premium of about 0.8 percentage points that has been consistent decade after decade after decade, in part because of what you heard about in the last session with respect to the business-friendly climate, lots of land, a little bit relatively low cost of living, and so you have all of these things contributing to that. We call it the Texas business formula. Again, I'm not going to belabor the point. I generally show this slide in Houston because we always love here in Houston pointing out when we're doing better than Dallas. But the whole Texas triangle had very strong job growth and has so far started out pretty good this year. RGV employment outpaced larger metros like DFW and Austin over the past 12 months, though. If you look at job growth over the last 12 months, so 12 months ending in February, this is what we're looking at. McAllen saw these are metropolitan areas. McAllen Metro 1.8%, Brownsville 1.3%. You'll notice our numbers are a little different from the stuff from the Bureau of Labor Statistics because we do a lot of work to adjust the data ahead of revisions, so our data is more accurate in real time. But good numbers there. I didn't forget about RGV. I've got RGV slides in here, so yeah. All right, before I move on, questions? No, you're ready for this to be over. All right, here we go. High-tech driving surge in real construction for manufacturing. This is nationwide data. Computer, electrical, and electronic is the big green area. That big green area there, this is private. This doesn't include the public contribution, which is a much smaller contribution. This is the dollar value of private construction put in place for manufacturing in 2024. This doesn't include any of that electrical stuff. People talk about batteries, people talk about the electric vehicles. None of that's even in here yet. This is almost entirely semiconductors, which Texas got an outsized share of. Why did we get an outsized share of? You heard several reasons earlier. One of the reasons is that we had a legacy semiconductor industry here and a number of universities that were capable of churning out skilled people. The other reason, and the one that wasn't said earlier, is that we have cheap natural gas. And that is a big part of what's underpinning a lot of the industrial expansion that we have seen, is that we have gobsmacking volumes of natural gas. It's got to go somewhere. And so cheap energy is a very, very big selling point for very many energy-intensive industries. And I would be remiss if I didn't also point out chemicals. We're still building a ton of petrochemical plants here in Texas for the purpose, largely, of export. Most of the petrochemical plants that have been built over the last 10 years were geared specifically for export, particularly to Asia, because that's where the population growth is. And so you can imagine this year's tariff announcements and trade war potential is of significant concern to one of our key industries in this country, in this state, petrochemicals. Overall, in Texas, construction has just generally outpaced the United States, and these giant surges in what we call non-building and non-residential is basically been driven by petrochemical plants, LNG plants, and semiconductors as you move along the timeline here. RGV construction activity has been growing faster than the state in terms of its percentage point. If you're looking at January 2018 as sort of your basis, you can kind of see the upward trend here. There's the LNG plant right there. And you can see these big lumps are always these big mega projects. But so moving in a good direction, you're seeing a lot of development there. Trade was growing through RGV ports. It has leveled off the last couple of years there. Just at this scale, it's kind of hard to see. It is still growing, but it has kind of leveled off a bit there. But this is going to be something that's very lumpy as big investment comes in and you get more capacity. That capacity will be used. So a big part of what you're going to see there is LNG facility gets built, you get a stepwise, this big jump growth. You get port investment, you're going to see this big stepwise jump because suddenly the volume, the capacity goes up. So you're going to see big lumpy jumps in these numbers for total trade moving through that port. And LNG, really, really big deal. So what you're seeing here, you've got, now I actually need to change this to, it's 8.5 BCF a day by 2030. This is the stuff we've already built. This is the stuff we're going to build and turn on by the end of the year. Some of it has already started to turn on. The Plaquemines, LNG, we're here, has already started to turn on. Some of these were delayed. You'll notice I pushed Rio Grande way back over here. I pushed it back a year because it's going to have to deal with the legal challenges to their permits, and that's just going to take some time. But it is going to get built, and we are going to see that big export growth. Now, new permits are coming. Companies are applying. They're going through that process. But some companies are simply not picking up the plans that they've already permitted. They're not building some things. There is a pipeline of, pardon the pun, of work that is already clogging up the available labor. We cannot accelerate the construction of LNG, especially if we're putting tariffs on steel, tubing, and machinery, much of which is imported and cannot be fabricated in the United States, probably in the next 5 years, maybe in the next 10, depending on what kind of component you're talking about. So this is going to continue to grow, and new projects are going to come online, but they're going to start entering the construction phases later in the decade, turning on in 2030s. And it must, and you'll see why in a minute. First off, oil and gas. By the way, does anybody care about oil and gas and what's going to happen here? Okay. Let me just say, break-evens ticked up. It got a little bit more expensive rather than cheaper for the first time in several years to drill a well. Tariffs are a part of that. And with oil prices where they are at $57 this morning, I think really probably just in the 60s, orbiting 60. This is barely going to be sustainable. And certainly at this price points that we've seen in recent days, I would expect a decline in drilling by the end of the year, a modest increase in the number of layoffs over what we would have otherwise expected because of consolidation in the industry, and slower production growth. In fact, when we run our numbers, For this year, we were expecting 0.27 million barrels per day of growth in the United States. This is the average of several different forecasts. Our forecast is 0.2, and we're debating whether or not that needs to be rounded down to 1.5 rather than rounded up. And when you look at 2026, it's flattening. The debate isn't, are we going to have flat growth in 2026 now? The debate is, could it be negative? And we start to see that leveling off. The Permian Basin, which is driving all of this, is expected to flatten out, plateau, in about 2027-ish. But they always beat expectations on productivity and technology, so maybe it'll be closer to 2030. But this is expected to plateau in terms of crude oil, all right? Natural gas will continue to grow, but it's not going to grow at the same pace it has. Why? Because most of the natural gas that have coming out of the Permian was not produced on purpose. It's an unavoidable consequence of producing oil. And they're producing the oil, not the natural gas. The natural gas they just got to deal with, which is why natural gas prices in West Texas have spent most of the past year at or below zero, because they physically have nowhere to put the stuff. Which brings us to our ports. So this is US exports, and most of this growth that you're seeing is coming through Texas ports. We've been an exporter of finished petroleum products, that's gasoline, diesel, and other refined products, for a long time. That's grown. Crude oil exports starting in 2013, but really picking up in 2017, those exports continue to grow. And everything in between oil and natural gas, which we're producing more and more of, those exports have continued to grow. Why? Because there's physically no one here to consume any of it. And if we do not export it, then we do not produce it. End of story. There's not going to be some major build-out of U.S. refining capacity. There's not going to be you are going to see growth in consumption, but we are not going to see a major turn in these exports. If we're going to continue to produce this stuff, we've got to export it to foreign markets. And you're seeing these huge growth across the board there. And this is what's happening with our natural gas. We physically have to get it somewhere else. Right now, it's a little high for a variety of reasons, higher than I would have expected, but that's basically because we had a much colder than expected winter. You get back to average temperatures on winter, those inventories are going to fill up, and the price of natural gas is going to go right back to $2 or $3 for the foreseeable future. The question for natural gas prices for all of the industries who want to invest here, the question for natural gas prices for all of the demand growth that we're going to have domestically, whether it is to power our data centers and AI, or some other industrial or other industrials, or all of the above, is going to depend on whether or not we build the pipelines out of the producing basins. We have plenty of resource to keep prices low. The question is, can we get it out of the ground and to the customers? All right, how am I doing on time? I'm almost out of time. All right, so here we go. Residential commercial real estate. Bottom line, folks, if you make it expensive to buy a house, people buy fewer houses. What do you know? Interest rates. And those interest rates have stayed up, and certainly based off of what's happening in the 10-year, it's kind of interesting to see, going to be interesting to see how mortgage rates evolve. But this is being suppressed by the fact that it's expensive to buy a house. Home prices in Texas have generally appreciated year over year at a slower pace than the nation overall. Why does Texas housing appreciate in value at a slower pace than the rest of the country? We're telling you about how all these people are moving here. Why isn't our home values growing at a faster pace than the rest of the country? Even here in Houston, where we've had all these boom-bust years. The reason is that in Texas, when you want to buy a home, we'll build you one. And it's relatively easy to build a new community. And so once demand goes up, supply generally keeps up. Easier in Texas than other states. And that has kind of kept our home values relative to other states and other communities low. In Houston, if you want to buy a new house, we'll build you a new house in the middle of a flood reservoir, but we'll build you one. Apartments. I'm not going to say too much about this except to say that when interest rates were low and rates were high, and occupancy was high, I should say, we decided to build record-breaking numbers of apartments. And as soon as those contracts were signed, everything went the other way, and the vacancy rate rose, and now no one wants to build an apartment, and we have this super cycle that's underway nationwide and across the state, where now we're finishing up. 2023 was the #1 year for new apartments in Houston. New apartments built in Texas, and the United States, other than 2024. And now we're going to see a dearth of construction. I'm not going to talk too much about this because I'm almost out of time, and they're going to kick me off the stage. So, forecasts. All of these numbers on this chart are going to be revised down. The question is how far. The numbers that I'm seeing are looking at either a 0.5 percentage point less GDP growth or a full percentage point less than GDP growth, given that the full tariffs that were announced the other day are not going to happen. But it is entirely plausible that that number falls to 0. So we have gone from a world where we looked like we were going to go to trend growth and the risk was slow growth nationwide, to an outlook where we're going to be going, this looks like we're going to slow growth, with the risk is that it could be something big enough to tip us into recession. We're not saying the recession word really yet, it's just slower growth. But until we get some clarity on the projection side, on the economic side, until we get some clarity that you guys are all claiming about policy, it's going to be really hard for us to kind of hang our hat on a number. And the inflation forecasts are going up. Businesses are very pessimistic about tariffs. You've seen a sharp turn in outlooks. They're worried about increasing costs of prices, and you've seen the input price indexes for firms skyrocket. They're going to kick me off the stage. Just give me the evil eye. All right, but here we go. So bottom line, I have all this geopolitics stuff. I should have skipped a few more slides. But anyways, future state and national supports for carbon, all these other things are going to go away, or they're uncertain. Bottom line, Texas is still growing. Slower growth is likely. But even if Texas growth were to slow even more than I have said here, not slow from 1.7 to maybe 0.7 as a result of the combination of effects of tariffs and immigration, which is entirely plausible. But if that happens, it is still my expectation, having worked with this data and lived for 15 years and lived in this state my entire life, that Texas will, and its regional metros, will still perform better year by year by year than the rest of the country because of all of the dynamics that you've been hearing about today. So here's the tell you what I told you slide. I don't think are you going to let me answer any questions? You're going to kick me off stage. She's checking, quick, while she's on social media. No, I'm just kidding. She's checking her calendar. Q&A, questions, comments, corrections, aspersions. All right. Well, thank you all very much. Y'all have a wonderful day.